You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today, we're joined with short-term rental investor Michael Chang. We're going to learn about how he went from Wall Street to short-term rental investor, how he did it, and a whole bunch more. So if you're into short-term rentals, if you're a professional, you're going to want to stick around for this one for sure. We'll be diving into all of that in just 1 minute. Hey, Tax Smart investors, big announcement. We're adding another episode to the lineup, and it's going to be a Q&A episode where we'll be taking questions from the listeners. Our first episode will go live this Thursday, February 20th, and be released every third Thursday of each month. If you'd like us to feature your question in a future episode, send it to contact@therealestatecpa.com or post it in the Tax Smart Investors Facebook group. We look forward to connecting with you and answering your questions, but for now, we'll dive right into today's episode. All right, and we're back. Michael, thanks so much for joining us here on the show today. Can you give our listeners a brief overview of your background and how you got involved in the short-term rental space?
Sure. Thomas, Ryan, thank you for having me on the show. Long-time listener, first-time caller, so appreciate the invitation. My background, and I think this show will be great for if you're a high-income professional and trying to figure out how to use real estate to lower your taxes. That was basically my journey. I was in investment banking here in New York City for 10 years as an M&A investment banker at Citi and Merrill, did my MBA at Cornell. So, was very much on that traditional track. And, 10 years, had some savings, paid a ton of taxes, 50% effective tax rate. And I was just figuring out a solution on how do I invest in real estate? How do I diversify my portfolio and be more tax efficient? And this is like 2019, and I had read something about the short-term tax loophole on Twitter. And my first instinct was like, this is too good to be true. And then I kind of put on my investment banker hat and it's like, okay, well, let's dive in here and let's see if this is real or not. I mean, after a bunch of research, it is indeed very real. And it's been transformational for me. It's helped me, my wife and I, exit our jobs. We do this full time now. We have 38 properties and we've saved a lot of taxes. So happy to hopefully illuminate some of this stuff for the audience.
No, that's awesome to be able to jump out like that. 38 properties at this point. Could you take us through a little bit of how you started? Like, were you still in investment banking when you started building your portfolio, or did you straight up leave and go full time, like just all in?
No, definitely did not jump straight in. I locked the trust fund, hopefully that I can pass on to my kids. So the paycheck was important to me.
Yeah.
And also there's just a lot of, time and energy spent getting into that seat. But it was, my then girlfriend, now wife, Liz and I were looking for something, a business that we could start together while we were both working. She was working at Kate Spade. I was still at Merrill. And, a lot of hours in investment banking. So I didn't have a ton of time to dedicate to this, but, it was something that was important that we wanted to do together before we got married. Because, ultimately we wanted to raise a family, and working 100-hour weeks and be on the road for 5 days a week just wasn't the lifestyle that we both wanted after we started a family. So, she had the interest in real estate. So I was really on her side. And, we started thinking about Airbnb, and we're like, what's this? This is 2016. So it's still relatively new. And, we had read about it. We talked to some people, and then her dad had a house here in New York. He lived on one level, and then 2 levels he rented out. And there was a vacancy. And we're like, hey, could we do short-term rentals? He's like, what? And I was like, we researched it. We'll pay the rent and we'll make sure nothing bad happens. He's like, you guys do what you're going to do, and, just return it back to me if it doesn't work out. It's like, okay, fine. And this was, we launched December 28th, 2016. I remember because we worked through Christmas because we wanted to get it launched. And it was, low season here in New York. It was, it's cold, and the design was pretty basic. It was like what I call an IKEA special. We just got some random furniture, put it together, and, took some photos on an iPhone and kind of see what it would do. And by March, it would do like $10,000 of gross revenue a month. And after the rent and the costs, we were netting like $5,000 low season. And you didn't have to be an investment banker or an MBA graduate to realize that, hey, if I took 5,000, we're going to do 5,000 per unit multiplied by X. You know, there was a pretty decent line of sight to getting her out of her job So that happened, by July of that year. And then, we continued to grow and learn and got me out of my job eventually. And, we do this full time. We have 2 young kids and it's been nice. We've been able to create a life that we both wanted. And, I'm very thankful for short-term rentals and the short-term tax loophole that, were enablers to help us get to where we wanted in, I guess, like 7 years now. So.
That's awesome. All right. You mentioned being in New York City and you mentioned starting in New York City. I know there's been the Airbnb ban. Like not all 38 are in New York City, right? You've got some in other states and things like that.
Yeah. So let me talk a little bit about the portfolio. So we have 38 properties that I like to say we control and or own. So we started in New York just because it was close, but you're right. There are new rules that were passed. We were out of the city by that time. COVID was not, when travel died down, we flipped that back into a long-term rental. And we had some stuff in New York and we were able to exit gracefully. But we have 30 apartments that we have under long-term leases in Philadelphia, which is about an hour and a half away. They are licensed and they're all done in the proper way. Those cash flow very well. And we've taken those profits and we've reinvested those into owning property. So we own 6 in the Smoky Mountains in Sevierville, Tennessee, about 12 hours away. So everything's managed remotely. We live in New York, but everything's managed remotely. We have 6 properties. First one we bought was we closed September of 2020. So not that early, but early enough. And then we ended up buying 6 before the last one we bought was June of 2023. And then, that was all 100% bonus, which was really nice. And then we just bought one about 6 months ago. We closed in June of 24. Our nicest property in the Catskills, which is about 2.5 hours north of New York City here. And, it's $1 million house. We put a bunch of money into it to make it really nice. And that's our 7th short-term rental. So it's 37. And then I help other investors execute the same game plan. So I have a mentee that works with me. She's a very successful real estate broker here in New York City, 7-figure commissions every year for the last 10 years, et cetera. She owns 3 very nice houses in the Hamptons. And then 2 we manage for her. There are like 3 million plus houses they do, 6 figures plus a year. So we manage those 2 for her and then 1 that she uses for herself. So that's 38.
Nice. So I know you mentioned you kind of started off in rental arbitrage. Why start in rental arbitrage and how has that specifically helped you to reach your goals of financial freedom?
Yeah. So maybe just to zoom out, just definitionally, what is rental arbitrage? I think there are a lot of people, there's some misconception. So I want to clear that up. So rental arbitrage, in very kind of simple terms, is you have a property that you control under a long-term lease and you have the owner's permission to re-rent it on Airbnb and the short-term rental platforms. And the goal is that there is an arbitrage between the short-term rental revenue that you earn, right, less the expenses on the rent and the OpEx, and then that's your profit. So we started running arbitrage, one, because we didn't know what the heck we were doing. So, buying something, and this is back in 2016, there's a lot less education available. We weren't ready. And we wanted to find something that, we can do for what was a fairly nominal investment, about $10,000, and to see if there was something here that we can actually do. So, if we lost all that money, it wouldn't have been, no big deal. Wouldn't have been happy, but it wouldn't have changed our lifestyle in any way. And, we could execute it quickly and proof of concept was there. And we continued to grow that primarily because of the cash flow. We wanted to generate enough cash flow so that it could replace my wife's then salary. And, with rental arbitrage, you can grow very quickly. You have something that works, you effectively copy and paste that to the extent possible. And so it's a very, very scalable model. You don't have to buy something and then, the mortgage and everything else, right? It's, hey, this works, this formula works. Let's rinse and repeat that as much as we can. And the scalability and the fact that you can generate, cash flows north of 40% was very, very appealing. And the payback was also very quick because you have a relatively nominal amount going in, call it $10,000. You can get that money back fairly quickly. And you have a business that generates cash flow for you. That, in my 10 years of investment banking, I hadn't seen a business model like that. And once I saw it and I saw the numbers, anyone with a calculator can kind of figure this out pretty easily. So we, really focused on that. Now, we probably should have bought in 18. We, hindsight saw it was 2020. I'd be a lot closer to retirement had I done that because everything, doubled or tripled since then. But it got us started, and we continue to run that playbook now for the last 7 years.
Does rental arbitrage still work in today's market?
Absolutely. It actually probably works better now than it has in the last 2 years. Rents have moderated, kind of that post-COVID bump. There was a lack of supply, a lot of demand for just have a product. Now there's more supply coming on market. A lot of stuff was built from 2020 on. So a lot of inventory is coming online now. And, effectively what you're doing is you're providing a business solution to these developers that have built these buildings. They need occupancy now more than ever. So they're good deals. You can, negotiate, structure something that is beneficial to both sides. You are running a business. They know what you're doing. You're paying the rent. They're covering their mortgage. Their investors are happy. So that's a very nice way to present a business solution to property owners that, when you're starting a new building, you're looking at, 200 units. We're going into a building that has 150 units that is launching in April. And, they're looking at a sub 10% occupancy. So it's a mutually beneficial solution. And now is better than it has been over the last 2 years because the rent part of the equation has come down materially. Revenue has moderated, but if you find the right product, right market, there's still, material opportunity out there.
Yeah, that makes a lot of sense because, the supply dynamic, I know that a lot of like multifamily properties have seen a lot of supply increase over the last year or two. So that makes sense that the rents are coming down, and that's like a main cost of the rental arbitrage business, right? It has to be the rent expense, right?
Yeah, I'll let you in and your listeners on what I teach, right? It's I take a very analytical approach to this. So if you're seeing stuff online, people a little younger, a little less experienced, I've been doing this for 7 years. I'm proud to say we've never lost money in a deal, and a lot of it is I think the investment banking background, just being very tight on what our underwriting is and being understanding what revenue looks like, what our cost is, and figuring out that equation. And doing this for so long. For every dollar of rent you pay, if you can generate $2 of short-term rental income, you're in a good place generally. South of that, gets a little tighter. North of that, time to quit your job and do it full time.
Yeah, that makes a lot of sense. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. I know you mentioned before that it's all managed remotely. And sometimes, we have listeners come on the show, whether they're buying their short-term rentals themselves or they're doing arbitrage, whatever the case is for them. Sometimes they have concerns about managing something remotely because the property's not in their quote unquote backyard. What tips do you have for automating and optimizing systems to manage a property remotely?
Yeah, that's a great question. The technology has come a long way since 2016. It's much easier to manage remotely now than it has been ever. So actually, it just reminds me, I just got off the phone with one of my mentees, and he's a very successful business owner in the Midwest, has a business that does 7 figures plus of free cash flow, and he just closed on a property yesterday actually, and it's the exact same question. He was like, "Hey Michael, all right, we closed now, like what do we do?" Without kind of going to all the gory details, right, you need the technology in place so that everybody can automate it through a central system called a property management system. So like that piece is very important. And then you need to build a team, right? The people on the ground, the people that can, people on the ground. So your cleaners, your handymen, and then, someone remotely, generally based overseas, that can help you with a lot of the admin work, things that can be delivered electronically. And then you wrap that all in business processes, right? SOPs, standard operating procedures, and you develop processes that allow you to utilize the technology so that you can run your business, from either 2 hours away from me, which is in Philadelphia, or 15 hours away from me, which is in Tennessee. I haven't been in Tennessee in over a year. I haven't been to Philly in a few months. Although I might go back down. Well, I'll wait until they clean the debris up after the Super Bowl and go down there.
Yeah.
But it's all very, very doable. You just have to do it the right way. There's a formula you can follow and you can do it the right way. And, the operator quality, your ability to execute as an operator, I think that's something that people don't think as much about. They go on these data websites and, look at a property like, okay, 123 Broadway can do, say, $100,000, right? You're not going to get $100,000. That's just false precision, right? You're going to be plus or minus of that. Now, a big driver of that, one, there's the unknown unknowns, like things can happen and the market changes and, that's just kind of business risk. But what the things you can control is like the operator quality, right? Like, are you going to do better than the incumbent there or someone that's close by to you? And that's something where through education and through experience, you can over-index that and do better than the average. And, that for us has been something that, we hang our hat on. We're definitely top quartile, top decile in many cases. And that allows us to generate outsized free cash flow, which allows us to grow our business. And one thing for people to know, for all the finance folks out there, look, it's a highly leveraged business model, right? Like, leases are leverage, mortgages are leverage. So you have to do this in a way that if you're doing arbitrage, there's no appreciation, there's limited tax benefits. So you just got to be really dialed in and, kind of squeeze that thing for cash, right? And you have a bunch of cash and then, you go to Thomas or Ryan here and say, hey, I have this profit and I owe the IRS now X amount of dollars. Now what do I do? And then, the short-term rental tax loophole, the things around buying real estate really come into play. And the beauty of it is once you start running arbitrage, you've kind of developed the muscle and how to manage remotely, how to optimize your operation. So you're starting with, kind of this sandbox that if you fail or like the magnitude of your mistakes are limited, when you buy something, the magnitude of your mistakes can be pretty detrimental depending on how levered you are and the profile of that property. So we always tell people, like, start with arbitrage if you can. You learn it, buy, and once you buy, you just put it onto your platform. You already have the technology, the systems, and the people already set up so that you can hit the ground running when you buy your property. And it works really well.
Yeah, it sounds like there's a lot of benefits for starting with arbitrage because, this lower risk, lower investment, you get to learn all the ins and outs, get to probably make your mistakes or whatever in the arbitrage business. And then when you finally do start, and it also gives you cash flow, right? Just be able to have the money to go buy a property. Now, once you buy the property, you already know what you're doing. Your risk is lowered. And now you get to take advantage of the tax benefits of owning real estate, but you're not taking on the risks necessarily of having to learn everything with the property you just sunk a lot of money into.
Exactly. It's like, if you're going to learn to drive a car, right? Like, do you want to start with the Civic, not the Ferrari?
Right. You don't want to crash the Ferrari.
You don't want to crash the Ferrari. No. Unless it's Ryan's Ferrari. Ryan, when can we get a ride? When can we take it out for a spin?
I think that's Tom that's got the Ferrari.
He's it's probably Brendan, actually. He's not even here right now.
He's out driving the Ferrari.
Exactly.
All right, cool. So let's take a second real quick to talk about the tax implications of doing short-term rental arbitrage versus actually acquiring the property yourself. So with short-term rental arbitrage, it's more or less you're running a business, but there's no physical assets, right? So there's not much to depreciate. You might have some furniture and some other things around that you might be purchasing for your business that might be able to be depreciated or might just qualify for the de minimis safe harbor. A lot of furniture will. Well, just you'll be able to immediately deduct it. If you're buying computers and other type of equipment like that, that's probably going to be tax deductible. But there's no physical real estate to depreciate. So that's the first thing to realize is with rental arbitrage, you're not going to be using the short-term rental loophole, which for anybody if this is the first time you're hearing about the short-term rental loophole, you must be new to the show. But basically, long story short, it allows you to take the losses from your rental properties, your short-term rental properties specifically, and use them to offset your active income, say a W-2 job or a business that you might be running. So that's not possible with short-term rental arbitrage, but it is possible when you actually physically buy the real estate. Ryan, I don't know if there's anything you want to add in here.
Yeah, I love that you said you can't use the short-term rental loophole like for short-term rental arbitrage. It's like two different things because the loophole, you own the property, and arbitrage, you don't. You're just renting it, right? And as the arbitrage side, you've got that major expense, which is usually rent, right? Maybe some other supplies and cleaning people or handyman, whatever that is. But usually like you don't own it, but your expense is the rent. And in replace of that, you've got the ownership for the short-term rental loophole. There, we do care about the average stay being less. You're materially participating specifically in the properties that you own. in the short-term rental arbitrage, we don't care about the average stay, to be honest.
Could I clarify something there actually? And tell me if I'm wrong here. So what I understand is the one material, and definitely agree with you on, there's no bonus because you actually don't own the real estate. So, everything that you're buying, the FF&E is either de minimis deduction or I guess you can you 179 that, right? Or no?
I mean, I think it's commercial, right? It's because we're running a business commercial.
Yeah.
So
Section
on that
179
note, so I'm curious on your feedback here. So what I understand is that for arbitrage, in order to step out of it being active income, so not paying the self-employment tax, if you materially participate, if you're in a 7-day stay and you don't provide substantial services, then it can still be Schedule E. Like it would qualify as a long-term rental activity. So you would step out of. So I think this is a big point that a lot of people I get questions on is it Schedule C or Schedule E? And I always tell people it's Schedule E because if you're in 7 days, materially participate and no substantial services, then it falls in Schedule E, and then you don't have the self-employment tax. And if you have losses from your other real estate, you can use that to offset. Say you're starting that calendar year and you have a bunch of stuff that you have now passive losses on, you can offset that against any other passive gain. Is that accurate? Or that's my understanding.
Yeah, so short-term rental arbitrage definitely goes on Schedule E because you're still renting. It's still a rental activity. Like that's still the underlying nature of what you're doing. And with that, it kind of follows the same rules as any other rental business. If it does have an average period of customer use of 7 days or less, then it could qualify for non-passive treatment if there are losses. If not, it would be passive, and those losses could then offset, if there are any losses, any other kind of passive income you might have from long-term rental properties. But yeah, basically at the end of the day, it's treated like any other rental business. If it's an average stay of 7 days or less, it will be non-passive. If it's above 7 days or less, it's going to be passive unless you are a real estate professional. So that's long story short, what you're looking at for this type of treatment. It's not going to be subject to self-employment tax unless you're providing those substantial services. So
yeah. That's why I always tell people don't do anything. Don't step outside of just cleaning the place. Some people want to do tours or rental, chef and just all these other things and try to like add the bells and whistles. And I just tell people like, look, you want to really optimize just the rental activity. One, you don't have to pay the 15.3% because once you step out of that, I don't care how much money you're making on, tours and all that other stuff. Like you're paying 15.3% on your tax. Like there's very little chance that that's going to come out to be a net positive for you.
Yeah, once you start providing substantial services, you are reaching into that self-employment tax territory. And for that to really make sense, you have to really ask yourself, are you making a substantially more money to make that tax worth it? And if it is, I mean, maybe it is worth the extra effort, the hassle, set all that up. But to be honest with you, we've worked with a lot of short-term rental investors, and I've not seen many really that do go that level of substantial services. Most of the time, they are just renting the space. That's what they're doing, and it seems to be working out for a lot of people. So, I'm not a fan of the self-employment tax.
Me neither.
Michael, maybe my last question here. So, as you think about being efficient with operations and, you've got 38 properties, I'm sure you're not the one who's sitting there messaging every single guest if they have a question. So tell us a little bit more about kind of virtual assistants. We kind of mentioned that, you're using people offshore, things like that. Tell us a little bit more about that. And if you're new in this, how might our listeners kind of use that to what you're using to be efficient?
That's a great question. Virtual assistants, people that you hire that are offshore, maybe in Latin America or in Asia, can be a real resource in helping you run your business more efficiently. So we definitely utilize a team of VAs that help us with a lot of the admin tasks of running our short-term rental portfolio. And we understand that there's a difference between material participation and real estate professional status. There's some really good content that you guys have put out on that. But we want to make sure that, we're hitting one of the 7 rules. I think the fact that neither one of us is a W-2 is helpful in, that fact pattern. But we want to make sure that between my wife and I that we are clipping 500 hours a year. And then, we use Reps Tracker and we log every single day, like what we're doing, has on our calendar, in our PMS system, in, all our technology. We just make sure that, if we're ever asked, that we can prove and have, kind of real time proof that like we're actually doing this. And it's easier when you have your spouse doing it with you because it's, 250 hours a year. So less than an hour a day on average for both of us, which easily attainable. And, making sure that our record keeping is good because the last thing we want to do is get that letter and, scramble, which, from my understanding is, something that has happened, a fair amount to folks. So we try to balance the VA efficiency with making sure that we materially participate and, have our grouping election so that everything is, all nice and tight.
All right. I got one more question. It's along the same lines. I think I've seen a post on this. I think it was LinkedIn from you. And it's about AI and how AI is totally changing up like the short-term rental space. It's like taking people's jobs and whatnot. But with that, it reduces costs for short-term rental operators. So I guess my question is, how are you currently using AI to optimize costs on your rental business?
That's a great question. It's top of mind. We've been testing different, AI technologies. We landed on AI chatbot that has worked really, really well for us. Right now, it can automatically answer 90+% of the guest messaging. There's little onboarding. It can just go read. It can automatically go in and read all the prior message history and just learn. And it can tune immediately on answering, fairly detailed questions on your property. So that's been a game changer for us. That's allowed us to be able to scale more efficiently as we have attrition in our staff. We don't need to replace the people because the technology is making our existing staff more efficient. On my LinkedIn, actually, I posted something. It's called the triangle of, it's a pyramid of your staff effectively. And there's like level 1, level 2, level 3, level 4, level 5. Basically shows that like if you're level 1 or 2 in anything that you do, you're going to be disintermediated with someone using AI because all that stuff can all be done now using these LLMs. And then as that technology gets better, you have to continue to level up your skills. And for our VAs, we really try to make sure that we're hiring folks that can think on their own, can create processes and really utilize AI as a tool. And they're not just parroting back like what's the Wi-Fi and copy and pasting that. Like that person that can only do that is not going to have a job in 2026. So, the more this technology that we use, we get more efficient, reduces our costs, allows us to be more competitive on our pricing, gives us an edge over our competitors. And we're exploring other things. I don't want to give out all my secrets, but there's, things with GPT operator and, creating custom apps that can do a lot of this workflow more efficiently, whether it's responding to reviews, finding reviews that are unfair, to ordering things automatically. There's the plane of opportunity is vast, and it's just exciting times ahead. And we're really excited that, we're able to, one, have the time to explore this and just kind of just intellectual curiosity and be able to implement some of this technology into our business. If you're a short-term rental operator, I think really any business owner, I actually have another mentee who has a network of medical offices and he has a number of Airbnbs and he's going to utilize this chatbot technology in his medical practices because a lot of that stuff is answering questions and delivering information. That's going to all be done by AI. So long way of saying, this AI train is real. Like you get on it, you get run over by it.
Right. No, 100%. People out there, you got to learn how to use AI to your advantage because it's here. It's not going anywhere. It's only going to get better. And it's seemingly moving at such a rapid clip. It's just insane. It's like, at first it was unbelievable when I started seeing what AI can do, but it's here. That's for sure. Mike, I want to thank you for joining us on the show today, sharing a lot of your knowledge here with our listeners, talking rental arbitrage, all that good stuff. Where could our listeners learn more about you and what you have going on? And maybe if they wanted to work with you or become one of your students or mentees, how would they do that?
So the easiest way to find me is on Instagram. My name is Michael Chang, BNB, MICHAEL, CHANG, BNB. Or you can find me on LinkedIn under Michael Chang. And I also have a podcast called STR Like the Best, so short-term rental like the best, STR Like the Best. So, it's very much focused on just short-term rentals and, talking with other investors that are in the business. And, if you're interested about short-term rentals, hopefully it'd be a good resource to further increase your knowledge in this subject. It's fun times right now. Things are changing rapidly, but there's still, I think, pretty material opportunity out here. This is still relatively new, right? Airbnb started in 2010. The professional part didn't really happen maybe 2017, 2018. So we're like less than 10 years really in the second chapter. So I'm excited.
Yeah, absolutely. We're going to go ahead and drop that into the notes for everybody out there. We know, a lot of people in our audience are into short-term rentals or wanting to jump into the game. So you can find that into the show notes. Thanks again, Mike. And I guess I'll catch you soon.
All right. Thanks, Thomas. Thanks, Ryan. Appreciate you guys having me on the show.